Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and will be licensable in July 2024. On this week's episode of Cross-Border Tax Talks, we're in Prague, Czechia, at PwC's EMEA International Tax, Legal, and Workforce Academy. We're excited to have Calum Dewar back on the podcast. Calum is an international tax partner in PwC's Washington National Tax Services practice. Calum, welcome back to the podcast.
I would say it's good to be here, but,
But the listeners, know exactly how you feel. I will tell you, Calum, that you are, I would say, probably my most requested guest, and it's been a while since we've had you on.
We need to work out who your audience is.
So, Calum, before we kind of dive into Pillar 2, how long have you been doing this? Like, you started your career in the UK. How long were you in the UK, and then how long have you been in the US?
Well, I ping-pong back and forward a bit, but in total I've been 20 years in the US and 17 years in the UK firm. So I'm entering into my 38th year.
It's amazing. And I've been doing this 25. It feels like a long time, and have certainly learned a lot from you over the years. And we've been advising on major deals and transactions. I mean, your entire career. How has international tax really changed? How can you try to summarize that and over your almost 40 years of practicing?
Well, I mean, I think, when I started, you have to remember that we had phones. They were landlines. We didn't even have a voicemail system. We had telexes, and you got a fax came through occasionally, but the fax faded to nothing within 3 days. So if you didn't action the fax almost immediately, you had nothing left of the fax.
It was like invisible ink
The
kind of thing?
ink just disappeared. It was the original technology. So, when you were doing deals back when I started, you would send a letter or a fax to your corresponding office, wherever it was, and then, a couple of weeks would go by and you may get a response. You may have to chase that response. The whole thing was just a process that took a long time. The communication, happened over a slow period. Time zones were a problem. It's not like now where, you got the internet, you got email, you got instant messaging. Things are answered almost immediately now. And I think also the knowledge of other jurisdictional tax systems was understandably limited. I mean, if you haven't got access to immediate information, you're relying on the person at the other end of the fax machine to give you an answer, and you've got no way to really sense check that answer against anything else.
There was no internet.
There's no Google. You couldn't look it up, so you had to just go with it, go with the flow. So, and it was a different time. I mean, literally, clients wrote you a letter to ask you advice. You meant to turn around that letter within a week, and the whole thing took, a significant.
And you would have to fax the non-U.S. office to be able to request a response to a technical issue.
Yeah, and I didn't have a word processor or a computer on my desk when we started. I had to dictate my letters and take them to the fearsome typing pool, where women sat there with typewriters waiting for the letters to come in, and where you got on the queue was depending on how charming you were to the typing pool. And so a box of chocolates every year was de rigueur to get your stuff through the typing pool as quickly as possible.
I recorded a podcast, I think it was probably 3 or 4 years ago at this point, with Richard McGinnis, who I know is one of your mentors, one of my mentors. And we actually spent an entire podcast talking about what the technology was like when Richard started, even before you. I mean, I started in 99, and that was just when people were getting laptops. Right, there were no phones. There were no Blackberries were several years after I started, even. So
I think my third year, I was given the first portable computer to take out to do a tax provision at a client.
Were you so psyched?
Portable was a very loose terminology for this thing. I mean, you had to be really fit to carry this thing to the client. By the time you got there, you were exhausted and had to take a day's rest.
But you've always been an early tech adopter. You had to have been a little psyched about having the machine, right?
Yeah.
All right, so let's move on to Pillar 2, because besides the technology, the layers of international tax have certainly continued to be added over the course of your last 40-year career. We're going to talk about the most recent one here is Pillar 2. So we're almost halfway through 2024. 36 countries have either enacted or officially announced they will be enacting effective 2024. The OECD is saying another 60 next year. We'll see what that number. But if somebody, Calum, from the OECD were to ask you today, how's it going with Pillar 2? How would you respond to that?
Well, there's a diplomatic answer and there's possibly a less diplomatic answer. I mean, diplomatically, I would say, the OECD did produce, a set of model rules, which it got everyone to sign up to. Quite an achievement in and of itself.
For sure.
And then has continued to, manage to issue implementation guidance in various forms and continues to do so. So, they're continuing the work in progress. And I think, at one level, they should be congratulated for achieving that, which is itself is not easy. Yeah. On the other hand, I do think, in hindsight, having an implementation process that starts with a retrospective date as from now, when you're still issuing fundamental guidance as to how the rules will operate, isn't leading to a particularly comfortable place for anybody. I think it's not comfortable for taxpayers. It's not comfortable for advisors who are advising somewhat in the dark, and it won't be comfortable for governments as they try and execute and implement their rules in relation to this. So I think, if you're in hindsight, I think it would have been much better to slow the process down. Once it became clear that the complexity of what they had designed necessitated significant further guidance, in my view, it would have been much better to slow down the implementation to allow proper discussion of those ambiguities and hopefully resolve many of the ambiguities so that countries could implement legislation that was holistic in nature. At the moment, what we've got is a situation where countries that have implemented have implemented a form of the rules as dependent when they actually decided to write their legislation. And then how they pick up changes as a result of guidance is going to be difficult, and we're going to end up with a situation where, whatever the OECD say, they say, well, so many countries have implemented these rules in a consistent format. That's just not true. They've implemented these rules, and they've consistently implemented these rules, but in a consistent format would be somewhat hopeful because it depends on which version of the rules they're following and which guidance.
And I'm seeing this as we're working with our Pillar 2 engine and trying to understand what all of those differences are so that we can get those programmed into the technology. You're right. Like, we've already identified, and you've helped work through a number of these issues where sometimes just the local tax policymakers just effectively did not appropriately cut and paste or transpose the rules. Presumably there were translation issues, but unintended consequences. Now, some of those can be fixed and amended,
right.
But then, and some are making distinct policy decisions about which administrative guidance, and then we have the December administrative guidance. So the discrepancy in the rules, I think I was expecting some discrepancy, but this has been a lot of nuanced as we've been working through this.
Yeah, I think if you roll back to when we got the model rules, I think I went on record at the time as saying, the hope that everyone's going to read the words the same way and interpret them the same way is, to my mind, an extreme hope. And then since then, all we've got is actual diversion from that policy anyway. So, when you've got things like the transitional safe harbour and the interpretation of a CBCR being different for different countries, and then you've got things like the QDMTT using like local financial accounts, which are going to be different in certain cases. So they've actually built in differences into the system of a system that was designed not to have differences. So you had a system designed that everyone would see it the same way, that in then trying to implement that, they've actually deliberately chosen to have variances. And those variances are very difficult to control. And then the interaction of these rules when there are those variances is very difficult.
Yes.
Especially when one of the key factors I think that's going to be very important going forward is, does a jurisdiction's QDMTT qualify for the QDMTT safe harbour? Why is that important? Because if it does, then effectively it turns off the other charging provisions, the IIR or the UTPR. If it doesn't, then yes, they can collect tax under that, but it doesn't stop the application of those other rules. And so if you've got a jurisdiction that doesn't meet the QDMTT safe harbour but has a QDMTT, then the problem is you're collecting taxes under a QDMTT. You may have incremental taxes under a UTPR or an IIR because other countries view the implementation of the rules in a different way than you did, that jurisdiction that applied the QDMTT. That peer review process to decide safe harbour QDMTT is sometime in the future.
Right.
And we don't know when in the future. We don't actually really know in detail how the process is going to work. But for the period from now until we get that QDMTT safe harbour, every jurisdiction is operating under an uncertainty as to whether the tax that's being collected under a QDMTT is the final amount of tax or just a part of the incremental amount of tax. And that to me is very troubling.
Yeah.
Because I think it's very difficult for companies and taxpayers and, again, revenue authorities to operate with that level of uncertainty.
And specifically, let's stick with the QDMTTs because this is a fascinating point, that we're starting to get a view on whether countries will use local stat accounts or financial accounting standards at the UPE, and just also additional details to your point on QDMTTs. We've identified, Calum, at least 2 of the countries that are implementing QDMTTs this year have elected to use local statutory accounting where that local standard does not do deferred taxes. Like, I didn't really appreciate that this was a thing, that certain jurisdictions don't do deferred taxes for local stat accounting. This can cause huge swings, right, for companies, for example, that are using tax loss carry forwards on whether they could potentially meet the safe harbor or they otherwise thought they would. Do you think that the countries that are implementing, I guess I'm asking you to speak on behalf of policymakers, but do countries understand what they're signing up for? And how are they going to just administer this? And the administration, I think one point, which is why I wanted to bring this up, is, well, who is the Supreme Court, or who is that group of policymakers that can decide whether something's qualifying?
Right.
But then each of these local countries are going to have to be able to review these returns, and there's wild differences, obviously, in accounting systems. And like the UK, for example, is allowing the financial accounting standard, the ultimate parent entity. So UK taxing authorities are going to have to be auditing for US multinationals, US GAAP-based calculations. Just how is all of this going to be administered?
You want the short answer? Likely badly. The honest truth is I don't think people have got into that level of understanding at the moment. I think, there was a wild panic over the last 18 months to get quotes unquote Pillar 2 ready. But that ready kind of focused on, where are my low tax jurisdictions? They're not necessarily focused on how am I going to actually do my compliance, because that compliance timeline is a bit of a lag behind. Do governments or policymakers understand what they've signed up to? If they do, then I've got to question why they signed up for it. I think, again, uncertainty in how you collect taxes is not no one's friend at all. It's not the taxpayer's friend. It's not the taxing authority's friend. It leads to massive uncertainty, likely leads to significant resource constraints both on the government and on taxpayers, and ultimately, litigation is likely to follow at some point in time on points of real uncertainty, which again just adds further complexity, uncertainty, retrospective interpretation of legislation. So I don't think people have really thought through some of those issues. In terms of the specific question on using local stats, I think, again, the OECD issued guidance. They said, a country can use local stats providing they meets various constraints, and those constraints themselves can cause massive uncertainty, but we can get back to that maybe. But the countries that have elected to use local stats, you can see why at one level that's attractive for a jurisdiction. They've generally collected their local tax returns based on the local stats. So why wouldn't you do your Pillar 2 local tax return using the same financial data? Where those, there is a requirement for a QDMTT as much as we know about it to be a safe harbour, permanent QDMTT safe harbour, there is a requirement in there about consistency with the rules. And, one may question the fact if there is no deferred tax applied in the local statutory accounts, and yet the Pillar 2 rules clearly require deferred tax movements to be reflected in the covered taxes, then how is the local stat consistent with the Pillar 2 rules, such that maybe the answer is you just don't get the permanent safe harbour in that case, in which case the local jurisdiction is collecting some level of tax, but maybe not all of the tax they could otherwise collect, or vice versa. But again, it will just lead to a situation where you've got multiple jurisdictions having to do a calculation to determine the amount of tax that should be levied.
When I promised you I wouldn't go too deep into the compliance, but it really begs for the centralized. You have to have because of the layers of these and the ordering and the potential issues that you may have, something is qualified or not, really having all of that in one centralized rules engine is so critical, given how these taxes relate to each other. Maybe let's move to, I wanted to get your thoughts, and we could spend a whole podcast on this, but the December administrative guidance that came out this past December 2023, I think we realized when that first came out just how prescriptive it was with respect to what constitutes a qualifying country-by-country report for the transitional safe harbor, and then some of the rules from the anti-arbitrage, which I think gave many of us PTSD from the experience of the ATAD 2 trying to interpret those rules. But any comments on the administrative guidance and the challenges that you're seeing out in the market as you work with taxpayers?
Well, yeah, I think there are two topics in that administrative guidance that are very important. I mean, there's lots of stuff in that guidance, but the two topics I think are very important. One is the stuff around how you take account of topside adjustments that are made in consolidation and how they should be reflected in the qualifying CBCR report, and if they're not reflected that way, the consequence is it's not a qualifying CBCR for that jurisdiction. And the difficulty we're finding with that is that, lots of companies have different ways of doing their consolidation. That's just practically the case. And what the inclusive framework guidance anticipated was that there's a process that every company follows, and it's the same process. They all do a reporting package at some local level. That reporting package is handed up to the head office. They do a consolidation, and that's what the guidance is based on. In reality, that's just not what happens. I mean, when I started 37 years ago, that may have been what did happen. There were reporting packages. They were sent by mail to the head office to do a consolidation. Now it's all done cloud-based, internet-based. People submit electronic data. That electronic data is then, whatever needs to be done to it to bring it into consolidation is done electronically. Then you have the question as to, well, if there's adjustments made, once it's been released from the local jurisdiction's trial balance to some other consolidation package, what the adjustments in that consolidation package do and how they're reflected in the CBCR report become very difficult. And actually, what I've found over the last 3 months is those conversations with clients start with the tax department, who generally have no idea what has happened to the numbers. They've not been interested in how those numbers are calculated. They didn't need to know how those numbers are calculated, didn't need to know the process. So what's rapidly happened is that you've had the conversation with the tax department, they understand why the issue is important, and they have to go and speak to their financial accounting colleagues, controllers, etc., to find out what process the company undertakes to do those adjustments. And they're wide-ranging. They can be transfer pricing adjustments, they can be stock-based comp, they can be pension, they can be any number of things that are dealt with by the head office, because the head office has the data to do it, whereas the local company doesn't have the data. But then how that's booked in the trial balances apparently is important for the purposes of the transitional safe harbour. Now, one could take a view that that was a somewhat ludicrous distinction as to how someone accounts in a trial balance for these numbers. If company A does it one way and company B does it another way, for them to get a different answer for a taxing provision seems, at least to me, odd. but that's where we are,
Right.
and that's the process we have to go through. So there's been a huge education process, and then now people are going away and trying to ask their financial accounting people to do things differently. And funny enough, that doesn't go down very well. So you've got the situation where tax departments are saying, well, we don't really want to ask our colleagues to change their
Right.
process because it's uncomfortable and they don't want to do it, and they've got a process and it works, and why change it, etc. So there's an awful lot of difficulty in that element of it. And then, of course, the other bit of the package that's caused huge uncertainty is the hybrid rules. And, again, you can debate whether a hybrid rule was required or not. Clearly, the inclusive framework concluded it was required and targeted against certain transactions that were being pushed in the marketplace around the transitional safe harbour. But what they've written is significantly broader than what they were targeting. Mm-hmm. And what we're finding in a lot of cases is perfectly normal commercial arrangements are being swept up by the broad definitions in the hybrid rules. And for US multinationals, that may be more severe than anyone else. And that's partly because the US tax system is very different than anyone else's tax system. Mm-hmm. The US has a worldwide tax system. It's not territorial. The US has checked the box and therefore has a plethora of entities that are treated as flow-through, treated as disregarded. And those two factors cause massive dislocation when reviewing the broad terminology of the hybrid rules. And so you're finding situations where if you were to follow the letter of the hybrid rules, you would have significant adjustments to make to determine the CBCR to be a qualifying CBCR for jurisdictions, and in some cases causing those jurisdictions that otherwise would have passed the transitional safe harbour, and actually from a policy perspective should pass the transitional safe harbour, are not because of these adjustments. And then those companies then have to go away and do a full Pillar 2 calculation on those jurisdictions for all that means, and the compliance burden of that again is, I think, unnecessary. Right. So I think again, if the rule was necessary, then write a rule that is targeted and specific in nature and not overly broad. And unfortunately, I think the OECD failed in that objective, and they've written something that's too broad for purpose, and that's causing huge difficulties for advisors and taxpayers to reinterpret it.
And this is a similar issue when we saw the anti-hybrid rules that came out in the EU with a TAD 2 that you could understand what there was trying to be targeted, but then all of a sudden all these other potential otherwise benign transactions have gotten swept up. So I think just it's important for listeners to understand, particularly this December administrative guidance, a lot of us thought that transitional safe harbor was going to be easier. Yeah. And to your point, there's massive process that needs to be taken. We need to take a look at to make sure that you can qualify for a country by country report. And then now there's an examination of structures that need to take place particularly for what otherwise wouldn't be considered what I think many of us would not consider a quote unquote hybrid arrangement, about whether those could get caught up. And listeners should also remember the OECD has publicly said that they want to bring those anti-hybrid rules into the full globe rules. So it's important for taxpayers to start to do that assessment.
And I think, that's where I think, again, real focus needs to be given is, and, I think this is somewhat a fault of the process we've gone through, is there hasn't really been proper consultation at the OECD level of what they write as rules. So, because I think, if they had issued the draft guidance as draft guidance to get comments on, they would have got feedback that it was applying to situations where I don't think even they thought it would apply to, and nor they think it should apply to. But they didn't seek that feedback. So now we've got this situation, like you mentioned, where there's clearly the threat being made that those rules will be applied into the model rules in some format. And so what we're struggling to make sure happens is that the collateral unthought through impacts of those words are corrected when it comes to actually applying the model rules. The alternative is they do what at one level might be the easiest thing to do, which is to say there should be a purpose let out in relation to application of anti-abuse rules, so that if you did things not with a purpose of achieving a hybrid arrangement or that, then it would be carved out. But unfortunately, the OECD have long steered away from purpose rules, and they did that with the hybrid rules when the original hybrid rules were written, and they've done that now. So they leave themselves the problem with, if you're not going to allow a rational review of purpose, then someone has to interpret the actual words you've written. And if you've written those in a way which catches, unfortunately, things that people agree should not necessarily be caught, there is no let out for it.
Right.
And that's an unfortunate scenario, I think, for everybody.
Another issue where we're seeing a lot of challenges and questions relates to deals and Pillar 2. We did a podcast come out over 18 months ago in September of 2022 on deals. I think it was Let's Make a Deal or something, some clever name that we came up with. We're 18 months from there, a little bit more than that. What are some of the issues that taxpayers should be mindful in the deal context? What have we learned since that last podcast, and what are some of the challenges?
Well, I think what we've learned is that my doom mongering in the last podcast was actually accurate.
pretty spot on.
And nothing much has changed, to be perfectly honest.
I think it's some of the same issues.
Yeah,
keep going.
I don't think we've got answers to many of the questions that were raised in that podcast in terms of certainty of treatment. There are, obviously, the starting point of this is, when companies do deals, they generally do some sort of ROI calculation, which includes a tax line. And, I think companies are now beginning to understand that tax line cannot look at the past effective tax rate of the target. It has to be adjusted for what you think the future effective tax rate of the target will be under Pillar 2. Clearly, if the target is big enough and is in Pillar 2 already, then you've got some chance of getting some of that data. But if you're buying relatively small targets that themselves would not have been in the threshold for Pillar 2, but are going to come into Pillar 2 because they're now joining your big company and they meet the thresholds, then that analysis of what the effective tax rate is significantly more complicated. So that sort of is out there. And then you've got the fundamental issues of the deal. Are you buying assets? Are you buying shares? Are you buying shares in a way which is treated as assets for tax purposes? The US, again, is somewhat uniquely placed, not uniquely, but somewhat uniquely placed around how they treat various things in the US with the check-the-box rules, treating entities as flow-through and therefore asset purchases is causing much confusion in the application of the rules. And unfortunately, much confusion in 3 different time periods. There's the period before the transition period, so before 2021. And if deals were done then, they still have assets that may be amortizing through the tax line.
Right.
The treatment of those deals that were pre-2021 is uncertain, and how they treat those for the Pillar 2 balance sheet. Then you've got the whole period of the transition period and how they are treated, and the provisions of Article 9 and 9.1.2, 9.1.3, which are causing, again, much confusion.
Which some taxpayers could still be in, depending on their structure, and if they don't have if the ultimate parent entity has not enacted the rules, for example.
And, when the transition period ends for a jurisdiction is not itself an easy analysis.
Right.
I mean, it can be, but in many cases, we're finding some difficulty in determining the exact point of a transition period ending, which matters because the transition rules treat things differently than model rules do. And then you've got the model rules and how they treat these things. And again, not really complete clarity on how these things are treated. There's easier analysis at some level in relation to things like purchases of entities that are treated as asset purchases, but even then you have to know how that's taxed on the seller's side, and often if you're advising a company that's the buyer, they're not going to know exactly how the seller is treating these things. And they can ask, but they may or may not get the information. And apparently, in determining how you're meant to treat this with Pillar 2 going forward, you need to know that. So that's going to be fairly difficult.
So I think what I found interesting, Calum, is the amount and type of information that is needed in a deal, just from a diligence perspective and information and how things were treated in those prior periods. That's a big game changer, and obviously it can influence kind of what that Pillar 2 position is for a taxpayer going forward. But then the challenge that we have in deals is the challenge we've always had, is that we're dealing with limited information. We've got a limited timeline. Yep. And so these are some of the most complicated issues, and really with no guidance, limited data, and limited information, taxpayers advisors have to make decisions, which I just think is incredibly challenging.
I think the other thing that should be made on the deals is, it's one thing where your deal is you're buying 100% of a company. You're taking it warts and all, you're buying into that, that's the reality. But we're seeing an awful lot of activity in the market that is joint venturing, whether minority interests or, true joint ventures. And the treatment of those transactions under Pillar 2 going on a go-forward basis is fraught with potential issues.
Agreed.
Which actually are true economic issues. Because it can end up with a situation where you own 51% of a joint venture, there's a top-up tax in relation to that joint venture, somehow you end up with more than 51% of that cost.
Yeah.
Economically, that makes no sense.
No.
I suspect it can be dealt with in the joint venture agreement if you know to deal with it, and some sort of shareholders agreement being able to reallocate the cost and the burden.
Agreed.
But if you don't know about it, and some of these deals obviously still in place and wouldn't have had that in there, then you're left with, I have to pay 80% of the burden when I only own 51% of the company. That makes no sense.
Right.
And advising companies that, unfortunately, it makes no sense, but that's the answer, doesn't make you particularly popular. And I've never sought a popularity contest with people I've advised, but it's uncomfortable telling them that.
Yeah, and the point is things need to be included in those JV agreements, and there's a lot of those relationships that exist where that issue is already out there. And so can you go to your JV partner, not in a great negotiating position, obviously, and figure out a reasonable way to make sure that the economic tax burdens are shared proportionately across the various economic ownerships.
Yeah, I think if you're an amicable joint venture, that's one thing. But the reality is, if I'm on the other side of the joint venture and you want me to pay for something, I want to be paid something for it. I mean, that's the reality.
One of the other things I'd do before we leave deals is the globe reorganization rules. And so, a lot of taxpayers, as they're thinking about a disposition, whatever, just reorganizing things within their group. And I think those rules were intended to allow companies, maybe particularly in the context of a disposition, move the wanted assets into, keep the company, and move the unwanted assets into sell the company. How applicable are the Pillar 2 reorganization rules to just some of these common tax-free transactions?
And I think that's relevant both in preparing for a deal, but also post-deal integration.
Great point.
So I think it's true both ways around. So I think, unfortunately, the way that the Globe reorg rule has been written makes it very limiting in its application. Now, whether that was intentional or not, we wait and see. We're waiting to get guidance on the Globe reorg. But as it's currently written, it's quite hard to see the application in real life. I mean, a lot of it looks like it should apply to normal transactions, like you say, carving up companies to do transactions or integrating. It all sort of falls into the general nature of what they say a reorg is, which is, merger, demerger, a distribution of a business, etc. They say the starting point of the definition is welcoming in its nature. And you think, oh, good, I've got something I can work with here. But as you then work through the parameters, in particular the last parameter, which talks about that it only applies where an acquiring jurisdiction gives tax basis in relation to the assets by reference to the tax law of the disposing jurisdiction. No jurisdiction writes their tax rules by reference to someone else's tax rules. That's just not the way taxing systems work. They work off their own. Now, they may coincidentally give you the same answer, but according to the words, that's not what's required. It actually says the law has to apply that way. So that Globe reorg definition is very limited if you read it the way it's written. Now, guidance could be forthcoming that says, no, we didn't mean it to be read quite that way. What we meant was
General carryover basis.
there shouldn't really be a step up in relation to this. And if there's not a step up, then the rule applies. If that's what they meant, they need to write it. Because at the moment, again, if you're an advisor being asked by a taxpayer, can I rely on this? Unfortunately, you're in the somewhat uncomfortable position of saying, well, we think it should apply to you, but unfortunately, the way it's written, we can't say it applies to you. And that's very important because, as you say, that's going to be relied upon increasingly in a world where these rules apply to deal with normal commercial transactions. So when I'm about to sell off a business line and I have to split up assets in various jurisdictions, I would normally do that. And normally there's local provision to do that, tax-free in nature if you don't get a step up. So there's local rules that allow you to do all this. But now we've got Pillar 2 over and above saying, well, hang on, even if the local rules apply, we can now apply a 15% to some phantom gain. And equally with the integration, if you make acquisitions, how you apply those rules on integration is very important.
Right. And the risk, just to make sure people are clear, is that if you have what would otherwise be a good reorganization for local tax purposes for your good assets, and you don't have a good globe reorganization, you've effectively created Pillar 2 globe income on the good assets,
Correct.
which is obviously not the answer that folks are looking for.
And obviously, if the local law says that's tax-free, that globe income is then effectively getting a cover charge of 15%
Right.
to do your otherwise benign
Right.
commercial reorganization.
So another trap for the unwary, we've gotten a lot of press on this particular issue, allocation of deferred taxes. Can you briefly summarize what is this issue? And we hopefully in the next round of administrative guidance will have some clarity on this.
Yeah. So, I mean, if you step back completely, I mean, Pillar 2 in its design, the model rules said, look, you've got to deal with covered taxes. And covered taxes included current taxes and deferred taxes with adjustments, but deferred taxes were part of covered taxes. So the model rules, effectively say your covered tax includes a deferred tax element. The model rules also say that if you have taxes that arise in an entity in relation to profits of another entity, that those taxes should be reallocated down to the source of the profits. And the two examples that come out big in the model rules are, if you have a head office with a branch,
Yep.
and the branch is taxed in the head office jurisdiction, the taxes the head office imposes should be pushed back down to the branch jurisdiction to determine the branch's effective tax rate. And the same is true for CFC taxes. So if parent entity levies a CFC tax on a subsidiary in relation to its profits, those taxes should be allocated down. And then the guidance had to then deal with quirks in relation to that around, whether it's passive income, things like the guilty regime and how you allocate guilty taxes, which are not a straightforward CFC regime, and was a blended CFC regime. So the guidance kind of dealt with all that. And I think if you read the guidance and the model rules, you would say, well, it also covered deferred taxes. There's no difference between deferred taxes and current taxes. However, one jurisdiction implemented the rules and apparently felt that deferred taxes should not be reallocated in that methodology. And so the UK wrote legislation, and broadly that legislation massively summarising, and I'm sure I'll get huge criticism from many UK practitioners, but at a very base level, what the legislation said was deferred taxes that are in relation to CFCs, for example, are not pushed down to the CFCs and indeed are not taken into account at the head office level either. So they just sort of disappear out of the equation.
And that's the big trap.
And that's a big trap. And now that can be benign, beneficial, or it can be
fair enough.
disadvantageous.
Fair enough.
So,
Could go either way. Yep.
You just have to work through the numbers. But I think you'd be hard-pressed to get that answer from the model rules. Apparently, that jurisdiction then raised this back up to the inclusive framework. The inclusive framework is now considering what to do with the deferred taxes. We are awaiting guidance to tell us what happens with those deferred taxes. It's further complicated by the fact there are a relatively small number of US multinationals who adopted deferred tax accounting in relation to their guilty inclusions and how to deal with that. And so that's only about 25 companies or something in that order, but they need to deal with that as well. So we're waiting guidance to tell us what to do with these things. It can cause massive dislocation to your effective tax rate if there isn't an allocation of deferred taxes. So one hopes that we get to a sensible answer on how these are allocated and that it does follow the methodology that is, inherent in financial statement accounting, which is if you're providing a deferred tax, is because at some point that will be replaced by a current tax. And if the purpose of introducing deferred tax into Pillar 2 is to smooth the impact of timing differences, then to not allocate deferred taxes against the profits that give rise to those taxes almost de facto will give rise to the potential for double taxation. And so we hope we get sensible guidance. We hope that moves it to a place where I think it should be, which is deferred taxes should get allocated. But I think we have to watch this space and see how the guidance comes out. Again, I think there's a degree of nervousness on behalf of the inclusive framework around are they giving something away in this regard. And what I would urge in relation to this on this podcast is nothing is being given away. The deferred taxes are calculated in a way that reflects the timing differences, which does smooth the impact of current taxation. That is its purpose. It has no nefarious purpose, and therefore to assume it does is only likely to give rise to double taxation at some point.
Anything else that taxpayers should be keeping an eye on insofar as future administrative guidance? We mentioned the anti-hybrid rules, this issue on deferred taxes. I mean, there's a lot of questions, and we keep obviously a formal list, and as we're going through all this with the Pillar 2 engine, but anything to highlight for listeners?
Well, I think we are expecting some more in relation to how to deal with basis in relation to at least US GAAP taxpayers. US GAAP has this common control standard, which means that transactions between group members never get reflected at fair market value. I think it's fair to say that the design of the rules did not anticipate that. We did get some guidance in relation to how to deal with that situation in relation to the transferor of assets on a go-forward basis. Didn't deal with the transferee, didn't deal with historic transactions either. So, how you deal with an opening balance sheet in relation to transactions that took place either in the transition period or in the pre-transition period under a US GAAP analysis could do with some clarification. Otherwise, we're just going to end up with companies having to take a view. So I think that's guidance we're looking for. I think the whole treatment of flow-through entities, we do have this somewhat bizarre situation where US companies, unfortunately, for all sorts of reasons, US groups operate real operations through things like LLCs, which are flow-through entities. They're fully taxable in the US because they're flow-through into US companies, but unfortunately, under the definitions of the model rules, they are treated as a separate class of citizen, otherwise known as stateless. The concept of being stateless then causes particular dislocation in the calculations going forward. So I think, again, it would be helpful to get some clarification on how to treat these entities that are fully taxable, but taxable at the level of the shareholder as opposed to the level of the entity. And again, it would be relatively easy to write a fairly benign adjustment to say, in the case of an entity that is 100% owned by a jurisdiction that fully taxes that entity, then to the extent it's not taxed locally, it should be treated as an entity in that jurisdiction, would make a lot of sense and would then make the operation of the rules somewhat simpler. So I think that's an area where we're looking for. Stacked hybrid entities are causing problems in these rules. So there's as you say, we've got a long list. I mean, if you want to go for about another 5 or 6 hours, we can get through, the first 10% of the list.
I would like to, but I've been told that our listeners may not be quite as interested. So maybe last question then for you, Calum. And, you're generally known amongst, our firm and partners with a cheery disposition and a just positive outlook on the future in general. What is your view on what's going to happen in 2025 when the UTPR kicks in? We'll see what happens with Pillar 1, but a number of DSTs, which are digital service taxes that could kick in throughout the world. we'll have, effectively this extraterritorial taxation, the likes of which we haven't seen before. What does all this mean in 2025? I'll give you the kind of the closing words here on, wow, this seems like a big train is coming down the tracks.
Right. Well, at this level, I can be supremely optimistic of what happens in 2025. I retire 30 June 2025. I am not going to care about Pillar 2 at that point. So it's over to the rest of you to deal with.
All right.
But I think the reality is there's a huge amount of potential dislocation to come. And I think if we think what's happened in the last 2 years has been confusing and uncertain and leading to odd results, I think the future is going to be even more uncertain and even more odd results. And I think things like the UTPR and how that works in relation to things like tax treaties. I know the inclusive framework are adamant that it doesn't fall foul of tax treaties. I think that is a point that others may differ on. Academics and advisors may differ on that. And so we're going to see quite a lot of dislocation in that regard as UTPRs start to be applied. We're in the kind of benign world at the moment, relatively benign world of QDMTTs and IIRs.
Right.
UTPRs are a whole different ball game, and I think it's going to get very interesting.
Good, and we'll dedicate more time to that as that time approaches, but I think there's a lot of interesting issues. So, Calum, thanks for joining. Always a pleasure to have you on, and love listening to you chat about Pillar 2, so thank you.
Pleasure.
Thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Calum Dewar, an international tax partner in PwC's Washington National Tax Services Office. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.